For our first video on basic tax concepts, I wanted to start light. So I loved being a tax lawyer because taxes are basically, it's a huge book of rules, but they all make a lot of sense. The logic is there. And the idea is to try to optimize your situation given the rules that exist. So there are different ways to structure yourself in the world for tax purposes and others. You can earn income as an individual. You can earn income through a corporation, through a partnership, a trust, and different rules apply to each one of those things. The first thing I just wanted to talk about with everyone is the concept of integration. And integration means that no matter which way you decide to structure yourself, you should be paying a similar amount of tax. Now, in practice, this doesn't always work, which is why tax lawyers get paid, because there are better and worse ways to do things. But you'll see that there are examples in the Tax Act always aiming to be fair. And two examples of integration are the refundable dividend tax credit and the capital dividend account. So those both occur for people who are incorporated. So if you have a corporation and there are shareholders of the corporation, those people who own the shares of the corporation, you have two potential layers of tax. So the corporation pays tax at a given level, and then when you pay dividends to the shareholders pay tax. The refundable dividend tax credit is to ensure that there isn't double taxation given that the corporation is paying a level and then the shareholders are paying a level. So they want to make it more similar to if you were earning income just directly to yourself, if you were not incorporated. And the capital dividend account is similar. So if you're an individual who earns money, specifically a capital gain, you're taxed on half of the amount of that capital gain, which is a favorable tax rate. If you're a corporation, in order to make that similar, or to provide that similar effect for the shareholders, when a corporation gets a capital gain, half of the amount goes into something called a capital dividend account, and that amount can come out tax-free, because if you were earning it directly, it wouldn't be taxed. Please let me know if you have questions.